Welcome to Breaking News to Trading Moves. I mean, imagine for a second opening up a small local coffee shop, and the very moment you unlock the front doors for the first time, aggressive investors just immediately hand you over $5.5 billion.
Yeah, and that is just because you promised them a slightly faster espresso machine. It sounds crazy, but that is effectively the level of capital enthusiasm we are witnessing right now.
It really is.
Yeah.
So Cerebras Systems just had its Nasdaq debut, and the stock opened 89% above its IPO price. And they raised $5.5 billion in the process.
Right, which is just a massive number. And for you as traders, you have to realize this event is about way more than just one new listing hitting the market. It gives us a very clear reading on market psychology.
Exactly. It shows that Wall Street still possesses this extremely strong appetite for AI compute, AI chips, and just the broader infrastructure needed to train and run large models.
Right. The money is just flowing relentlessly into the hardware layer. But that brings us to the core trading question we really need to answer for you today.
Yeah, how do we actually read this signal? Does a debut like this confirm another leg higher for the entire AI trade?
Or, and this is the flip side, does it show that valuations are just getting way too hot right now?
Right. Are they disconnecting from reality?
Yeah.
Because to answer that core trading question, we first need to look at who directly benefits from this strong appetite for AI compute.
Exactly. We have to evaluate the ecosystem. So the obvious first group of winners here are the established AI chip leaders and the semiconductor designers.
Okay, so we are talking about tickers like NVDA for NVIDIA and AMD for advanced micro devices, right?
Yes, along with AVGO for Broadcom and MRVL for Marvell Technology. Cerebras having a strong debut proves investors still just desperately want exposure to AI compute.
Wait, I need to jump in and challenge this premise immediately. Because if a brand new competitor like Cerebras enters the public market flush with over $5 billion in cash to build faster chips, how does that help NVDA or AMD?
I know, it sounds totally backwards, right? You would assume a well-funded rival taking market share is just a direct threat to the legacy players.
Exactly. I mean, it feels like they should be losing ground.
But market psychology around emerging tech operates a bit counterintuitively. A wildly successful IPO for a challenger actually proves to skeptical investors that the market for AI compute is expanding.
Ah, so it shows the total pie is getting bigger.
Right.
Yeah.
The enterprise demand is so robust that the market believes it can easily support new entrants without actually starving the legacy players at all.
Oh, I see. Because the established chip names already possess exactly what the newcomer is promising to build in the future.
Exactly. Companies like NVDA already have billions in verified quarterly revenue, they have entrenched customer relationships, and they have immediate data center deployments.
Plus, they kind of have the whole software ecosystem locked down, don't they? I mean, NVDA remains the benchmark for everything.
Yeah, they really do. Every single data center measures its raw performance against their architecture because developers already know how to code for it.
And AMD is already out there winning more accelerator share. They are securing these secondary supplier contracts for data centers that just want an alternative option.
Right, the data centers want that option just to maintain some negotiating leverage. But we also have to look beyond just the primary processors here.
Okay, so this is where AVGO and MRVL come into the picture.
Yes. They operate in custom silicon and networking chips because building an AI data center requires linking tens of thousands of individual NVDA or AMD processors together.
Let me just put an analogy out there for you to explain this, because chips are essentially the engines, right? But the cloud platforms and networking are the highways.
That is a great way to look at it. Connecting 50,000 independent processors is not like plugging standard laptops into a wall router.
No, it is more like trying to put 50,000 master chefs in a single kitchen. And then you ask them to cook one highly complex meal together without bumping into each other or dropping the ingredients.
Right, which would be total chaos without coordination. So the networking chips, the ones from Broadcom and Marvell, they are basically the traffic controllers ensuring the data does not collide.
Wow, okay, so that networking requirement must scale up pretty aggressively, right?
It scales exponentially. As AI models get larger, the processors must talk to each other constantly. Broadcom and Marvell build those high-speed data pathways.
So when a data center buys the primary processors, they absolutely must buy the networking hardware to make them function as a single supercomputer.
Exactly. But here's the thing. All these chips and traffic controllers are entirely useless without a physical place to house them.
Right, because a startup building a new language model cannot just buy 50,000 high-end chips and run them out of a suburban garage.
No, they lack the capital to buy the chips up front, they lack the industrial grid access for electricity, and they totally lack the cooling technology.
Which brings us to the cloud and AI infrastructure platforms. We are looking at AMZN for Amazon, MSFT for Microsoft, GOGL for Alphabet, and ORCL for Oracle.
Yes, these platforms are the ones turning raw, prohibitively expensive compute capacity into a readily accessible rental service for developers.
Because they actually absorb the massive capital expenditure of building the data centers,
Yeah.
and then they lease that compute power out by the hour. Right?
Exactly. I mean, MSFT leverages Azure and its OpenAI workloads. AMZN has massive AWS exposure. GOGL runs its own proprietary AI stack.
And ORCL is expanding its cloud infrastructure specifically to secure these massive contracts for AI workloads. So they have the land, the power contracts, and the liquid cooling.
Right, and that scale is just the ultimate barrier to entry.
So let me ask you this. Does this mean these specific platforms are winning purely because they're the only entities massive enough to actually turn these chips into a usable service?
Basically, yes. Scale is the only metric that matters at this layer. Building a single modern AI data center costs billions of dollars and takes years of planning just to get the electricity hooked up.
Wow. And there are maybe, what, a dozen companies globally that can actually write those checks?
At most.
Yeah.
But, because the cloud platforms like AMZN and MSFT need to deploy these chips at a massive scale, that naturally brings us to the next group of winners.
The physical supply chain,
Yeah.
the builders behind the scenes. Because you cannot just pull millions of advanced NVDA or Cerebras chips off a warehouse shelf somewhere.
Right. They have to be physically manufactured from raw materials, and that requires semiconductor equipment and advanced manufacturing.
Okay, so the tickers to discuss here are AMAT for Applied Materials, LRCX for Lam Research, KLAC for KLA, and TSM for Taiwan Semiconductor Manufacturing.
Exactly. More AI chip demand absolutely necessitates more physical wafer production, process tools, inspection equipment, and advanced foundry capacity.
So a positive message for the semiconductor supply chain basically equals more chip manufacturing investment across the board.
Yeah.
Let's get very specific about what these companies actually do for you, the listener.
Sure. So AMAT and LRCX engineer the actual process tools. They build the machines that deposit microscopic materials onto silicon wafers.
At the atomic level, right? We
Yeah.
throw around terms like wafer production, but it really borders on pure science fiction.
It really does. They are etching intricate patterns to create tens of billions of individual transistors on a piece of silicon roughly the size of a postage stamp.
That is just incredible. And then KLAC handles the inspection phase of that process, correct?
Yes, and that is critical. If you are building a chip that costs $40,000 and you manufacture hundreds of them on a single wafer, a single microscopic speck of dust can destroy the entire batch.
Oh, wow. So yield management really dictates the entire profitability of the operation.
Exactly. KLAC provides the metrology equipment that detects defects that are quite literally invisible to standard optics.
Because if a manufacturer's yield drops from, say, 90% down to 70%, their profit margins just completely evaporate.
Instantly. And as AI chip architecture gets more complex, the cost of a microscopic defect rises exponentially. That makes advanced inspection tools totally mandatory.
Right, which brings us directly to TSM, because they are the actual factory floor, aren't they?
They are. NVDA, AMD, and even newcomers like Cerebras do not actually build their own chips. They don't own the factories.
They just draw the blueprints, essentially.
Right.
And then they send those designs over to TSM to perform that atomic-level manufacturing.
Exactly. So if Wall Street is throwing $5 billion at a new AI chip designer, that simply means TSM is getting another massive customer added to an already backlogged schedule.
TSM really remains central to AI processors. They dictate the physical pace of the entire industry.
Right. If they cannot expand foundry capacity fast enough, no one gets their processors. Period. So a bullish signal for AI demand translates directly to multi-year backlog security for TSM.
And guaranteed equipment orders for AMAT, LRCX, and KLAC. But, capital on Wall Street is finite.
It is very finite.
So if billions of dollars are aggressively chasing pure AI compute and the tools to build it, We have to look at where that capital and attention is moving away from.
Right. We have to evaluate the losers here, or at least the companies facing an immediate drain in attention.
Let's start with the chip incumbents facing higher competition risk. The tickers to discuss are NVDA for NVIDIA, AMD for Advanced Micro Devices, INTC for Intel, and QCOM for Qualcomm.
Wait,
I know. Listeners are probably shouting at their screens right now. NVDA and AMD are on both the winners and the losers list. It is a glaring contradiction.
it does seem like a paradox, but it makes sense when you break it down. The exact same headline that boosts AI chip sentiment also reminds investors that competition is increasing.
Okay, so how does that actually threaten them if they're still making money?
Well, new architectures raise questions about whether future AI compute growth will be spread across more players. Right now, companies like NVDA enjoy commanding market share.
And their stock is priced for absolute perfection, right? Assuming they maintain a near monopoly.
Exactly. When a company like Cerebras successfully enters the market, it creates valuation pressure if traders think the market is too concentrated. It introduces the severe threat of multiple compression.
Okay, define multiple compression for me in practical terms. What does that actually look like for the stock price?
Sure. Think about the premium you pay for a stock relative to the earnings it generates. If a company has a total monopoly, investors might pay $50 for every $1 of profit.
Right, that is a very high multiple.
But the moment a viable competitor proves they can take even 5% of the market, that monopoly illusion totally breaks.
So the established company might still grow its actual earnings, but investors are suddenly only willing to pay $30 for every dollar of profit.
Exactly. Because the risk profile changed. The earnings went up, but the stock price crashes because the multiple compressed.
Wow, so if NVDA's specific slice of the total pie starts to shrink in percentage terms, the market will punish their valuation pretty aggressively.
That is the exact risk portfolio managers are losing sleep over. And for legacy incumbents like INTC and QCOM, the pressure is drastically worse.
Because they are trying to defend traditional, slower growth computing markets while burning billions just to pivot toward these new AI workloads.
It is a constant tug of war between expanding opportunity and expanding competition.
And speaking of slower growth, that brings us to traditional enterprise hardware. They are feeling the exact same capital drain.
Yes. We are talking about tickers HPQ for HP, DELL for Dell Technologies, HPE for Hewlett-Packard Enterprise, and CSCO for Cisco.
Slower growth hardware names just look less attractive when capital chases pure AI chip exposure. But wait, I have to push back on this a little bit. DELL and HPE are the ones physically building the servers. A data center needs massive server racks and intense power management. Shouldn't DEL be printing money from AI server demand?
They are seeing AI server demand, sure, but margins remain a massive concern if most of the value sits with the chips.
Oh, I see. So if DEL sells a state-of-the-art AI server rack for $3 million, how much of that actually stays with DELL?
Well, the vast majority of that price tag, sometimes over $2.5 million of it, goes straight back to the company that designed the chips inside it.
So DELL does all the heavy lifting of bending the metal, building the heavy chassis, and plumbing the cooling, but they only capture single-digit profit margins.
Exactly, because the chip designer holds all the pricing power. The market awards the premium valuation to the intellectual property, not the metal casing.
Growth-focused investors will always rotate capital toward the high-margin silicon designers.
Right. We saw the exact same dynamic play out with CSCO during the early internet hardware build-out. Initial equipment providers see a revenue spike, but long-term margins compress really quickly.
Which perfectly explains the final group facing a severe attention drain, software names competing for AI attention.
Yes, the tickers here are CRM for Salesforce, ADBE for Adobe, NOW for ServiceNow, and SNOW for Snowflake.
A hot AI chip IPO basically pulls all the attention away from software, even from companies with really strong AI messaging.
It does. Investors start to question whether software firms can turn AI features into faster revenue growth, or if near-term monetization just remains stronger in chips, cloud, and infrastructure.
But look at the adoption of enterprise AI copilots. Every single software company has added a generative AI text box to their dashboard recently. Is that not enough to keep Wall Street happy?
Investors are demanding actual proof of monetization, and the software layer is really struggling to provide it right now.
Because enterprise customers view cloud compute as a mandatory utility bill, right? They have to pay AMZN or MSFT just to keep the lights on.
Exactly. But asking a customer to pay an extra $30 a month per employee for a software tool that drafts emails, That is entirely discretionary spending.
Yeah. So during corporate budget cuts, a company keeps the servers running, but immediately cancels the premium email drafting tool.
You nailed it. The hardware companies are selling concrete building blocks. The software companies have a much higher burden of proof to show customers will tolerate price increases.
So mapping this entire landscape out for you, there are two distinct trading paths forward based on Cerebra's debut as an AI sentiment signal.
Right. The bullish read assumes demand for AI infrastructure remains incredibly strong, and that supports the designers, equipment suppliers, and cloud platforms.
And then the cautious read suggests AI valuations may be running hot. If capital flowing into hardware sets unrealistic growth expectations, any new competitor gaining traction could trigger multiple contraction for current leaders.
You really have to monitor the physical supply chain metrics just as carefully as software adoption rates to see which path becomes reality.
That leaves you with a final thought to ponder. If near-term monetization remains heavily skewed toward hardware and infrastructure, which is generating cash right now, how long before software companies face a reckoning to prove they can match that revenue growth? The clock is really ticking on that. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.